Welcome to TheoTrade. This is Don Kaufman. In this video, what we're going to discuss is kind of what I call the Volatility Trap. That's the theme. That was the title on here, the Volatility Trap. And I'm going to show you a little bit about what I call the Volatility Trap. And I think that a lot of traders really fall into this trap because when you do become relatively experienced in options and options trading, okay, lots of people look at things like implied volatility. So in this example, I've actually brought up Lululemon. It's not Lululemon or anything French along those lines. It's just Lululemon. Anyway, the reason I brought up Lululemon is if you look over to the right-hand side of the screen, the implied volatility is screaming at you. What's it screaming? It's screaming earnings are coming. It's coming! Now, I don't even have to look at a chart to determine that earnings are coming. And I can see the volatility. It's all puffed up. Okay, it's all puffed up. It's like the puffy shirt over here. It's all puffed up right there in the 6-day expiration cycle, and then of course drops off just a little bit. That's really indicative, of course, of an earnings play. Now, what's the volatility trap? The volatility trap is what a lot of traders have tendency to do is they'll open up the 6-day options and they'll be like, "Ooh, volatility is rich." Is it? So volatility is rich. It's at 93%. And what's going to happen is Lululemon is going to release earnings later this week. Okay. And again, you know, I don't even need to look at the chart all that often in really determining, you know, okay, so what day? But in this example, when are they going to release? And, you know, I'm recording this here on a weekend. It happens to be 12/9 before the market opens. So we're just a few days out. And what's going to occur every day, okay, every day prior to Lulu coming out with earnings is the volatility is going to creep up. It's going to creep up. It's going to creep up. It's going to creep up. Why is volatility going up? Okay. Well, people are always going to jump out, you know, of the woodwork and go, volatility is going up because there's more risk because earnings. Okay. This is Captain Obvious kind of stuff. The volatility is going up because of earnings, but we already know the earnings date. We knew the earnings date last week. We knew the earnings date a couple of weeks ago. So if we've already know the earnings date, we're like, what? You don't see the risk in front of you? Like, this is the train. It's coming. I see it. Why is volatility really going up? Volatility is really going up to offset the decay. So what happens before earnings is this. Okay, what happens in all options? So here's 6 days left. So there's our 6-day time window. And with 6 days left, that's what time looks like. And then it just drops off eventually to these options are at 0, right? People have actually seen a decay graph. This is a decay graph. This is Don's very poor attempt at drawing a decay graph. So the options start to decay the closer you come to expiration. Right now, here's 6 days. Here's 0 days. The options that are out of the money out here and out here are going to go to 0. Now, what's happening is the reason the implied volatility is truly going up, okay? I think that's the sign for the male. We'll draw the female later. But the reason the implied volatility is going up, it's actually to offset the decay. So what's going on is that the options in the chain, okay, they're like, this option right here, it's right around like $2.50. The option goes, I'm $2.50. I'm $2.50. And the options have to remain okay, very close to $2.50 in this, you know, particular put that I'm looking at. And what's going to happen is the implied volatility is inversely proportional, okay, to the what? To the decay. So the implied volatility is actually going up. And why is it doing it? To offset the decay. So the options don't decay like they should. What's going to happen is before an earnings announcement is the options are going to decay like this. They're going to be like, I'm flat, I'm flat, I'm flat, I'm flat, boop, and they're going to go right down eventually to 0. They're not going to follow that, you know, that standard decay graph that you would expect. So this is part of the implied volatility kind of trap in this case. I know. We've got everything from male to the drop-off over here to inversely proportional implied volatility versus theta over here. I know, it's getting kind of insane. But the point that I'm trying to make with this is the implied vol going up, that's part of the trap. What's the trap? Well, the trap is simply put as this. People go out there and they sell what they think is high implied volatility, and then they buy for example, lower implied volatility. Okay, and let's say they buy like the 19-day options. So they're selling what they believe is going to be high vol, and they're buying what they believe is going to be low vol. Okay, but when it comes down to it, the volatility before the earnings announcement is kind of a facade. It doesn't mean that you can't sell high vol. You can sell high vol. But when you're selling high volatility and you're buying what you perceive to be lower volatility, you're just fooling yourself. So let's open up two different expirations here. Okay, and I'll show you exactly what I'm talking about. So here we have the exact same option. Here's a 49 put, and here's a 49 put. 49 put, 49 put. One of them is for 6 days, one of them is for what? 19 days. So case in point over here, the Vega. Now a Vega, all right, is an options sensitivity to changes in this implied volatility. And what Vega of 3 cents means, it means kind of for every 1 full point. Now 1 point, you're like, what's a point? Well, that's when it goes from 93.38 to 94.38. For every 1 point that the volatility moves, the options over here, these 49s, are going to be affected by 3 cents. The options out here have almost double the volatility risk that they do here. What does that mean? It means when the vol drops, and it will drop, like after the earnings come out, this will go from like 93 and it's going to get crushed all the way back down to like what? So probably like 50. So it can lose 40 volatility points. And when it loses the 40 volatility points, the premium is going to come sucking out. It's going to suck the premium's will to live out of these 6-day options that you sold. You're like, yay, these options that you sold, the premium gets sucked out. Problem is the options you bought are also going to get vol crushed. Okay? Now they're not going to get crushed as much. They're going to get crushed from like, 64 all down to maybe 50. Okay? When they get crushed though, their volatility component is almost twice as large, okay, as the 6-day options, meaning their Vega risk is almost 6 cents. Rounded up, this is actually closer to 6 cents. I know it says 5 cents, but if you take it out to multiple decimal places, it's almost 6 cents. And in this case, okay, all right, so it drops by 14 volatility points. This one drops by what? By almost 40 volatility points, yeah. But the volatility dropping in the 19-day options is going to hurt you because that's the option you own. So really what I'm talking about here is, again, this quintessential volatility trap. So here at TheoTrade, we're going to look at a lot of different ways to kind of not succumb to things like volatility traps, that there's ways to effectively trade things like this without getting caught up in the notion like, oh, this must be a good trade. Volatility is really, really high. Well, high volatility indicates one thing, more risk. So you buy high volatility? No. Do you sell high volatility? Sure. But if you sell high volatility, you better know the volatility differential and the Vega risk from the short duration option to the long duration option. Thanks a lot, everybody, for joining us here at TheoTrade. This is Don Kaufman.